Hi, because this tutorial is about investing, I need to add this disclaimer and make you aware that I'm not aware of your personal circumstances and not providing personal financial advice. So please pause and have a read. Thank you. Hi, welcome to this Accofina tutorial on technical analysis. In this tutorial, we're going to just give a brief introduction into what is technical analysis in general. We're going to explain the fundamentals of technical analysis. Now, we're not going to go into specifics about particular techniques or indicators. We're just giving the fundamental theory of TA. So what are we going to cover today? We're going to explain what technical analysis is in one sentence. We're going to talk about the alternative approaches to investment analysis. Then we'll move on to who uses technical analysis and for what type of investments. Then we'll talk about the core assumptions and principles underlying technical analysis theory. Then we'll talk about what technical analysis do. I might actually use the abbreviation TA. TA is another way to say technical analysis. I've already said technical analysis about 10 times and I'm already getting tongue-tied. So if I say TA, you know what I mean. Okay, then we'll talk about what do TAs look for within their charts, and finally the advantages and disadvantages of the technical analysis approach to investment analysis. Okay, technical analysis in one sentence. TA is an investment analysis technique that uses historical prices and volume data to predict future security and investment prices. So in other words, it's a way to pick your investments using historical price and volume data. And we'll just go to a quick real world example. We're going to have a look at the Apple stock using a candlestick chart and seeing some volume bars. Okay. Alright, so here we have Apple listed in the US and the chart of Apple. Currently you'll see that Apple is $219.70 at market close. And this is the price of Apple from approximately mid-March all the way up to September. So it looks like probably the past 6 months or so. You'll see price moving along here. These are candlestick patterns, or this is a candlestick chart. I'll go into that in a second. And down the bottom you see you have the volume bars. Now the volumes represent how many Apple stocks or how many Apple shares were traded that day. So here you'll have this many Apple shares traded, and the previous day there were far fewer Apple shares traded down here. These two were similar, then there was a lot here, then it goes back down to here. So they're the volume bars along the bottom per day, and here are the individual price movements per day. And why are they called candlestick patterns? Well, let's zoom in here, and we'll have a look. Okay, so here's the typical one. Now generally, they're called candlestick patterns because there's a waxy center with wicks coming out the top and a wick coming out the bottom. The top and bottom wicks explain the high and the low of that particular day. If it's a green bar, it means it's moved up. If it's a red bar, it means it moved down over the day. And the open was the left-hand corner of the wax, and the close was the upper right-hand corner of the wax on an up day. And on a down day, the open was the upper left-hand corner of the wax, and the close was the lower right-hand corner of the wax. So that's what they're called, candlestick charts. So essentially what they're showing is the open, the high, the low, and the close of every single day or period that you set it to. And you still have the volume bars down the bottom. So that's just a quick little example. We'll get back to our presentation to explain the rest of technical analysis. Okay, so that was our real world example. Alright, so what are the alternative approaches to investment analysis? There are three major approaches to investment analysis and investment selection. And this is where you can get some sort of context into where technical analysis fits in. Now, first of all, there's fundamental analysis, and that uses accounting, company, industry, and economic information for valuation techniques. Then we have technical analysis, or TA, and that uses historical data based on prices and volumes to create buy and sell signals. And then finally, we have quantitative analysis, which uses both fundamental and technical techniques to generate quantifiable mathematical models. And who uses TA for what investments? And while there are some exceptions, and there are some investors that use TA, most technical analysts are traders. And when I say traders, they hope to profit from intraday or short-term or medium-term buy and sell. So they have a shorter-term time horizon than an investor. They don't just buy and hold. They try to buy and sell, or sell and buy, within the day or over a couple of days, or in the medium-term horizon, a couple of weeks to a few months. And TA is particularly used for investments that don't pay dividends or other income. In other words, investments that rely solely on price and capital gains. So things like some stocks, commodities, options, other derivatives, and of course cryptocurrency. So when these investments don't pay dividends or income, the only way you can profit is from buying low and selling high, or selling high and buying low. And that's why picking a bottom or picking a top is very useful. So what are the core assumptions and principles of technical analysis? Now, if you're going to take this approach to investing, you have to kind of have some underlying beliefs about the markets. There's no point using this technique if you don't kind of believe in the underlying assumptions behind the approach. So what technical guys believe is that market moving trends, and that trends will continue more likely than not. TAs believe that prices reflect supply and demand, and that any particular price is where buyers and sellers agree in aggregate. If there were any more buyers in the market and they didn't agree, then the price will go up, and vice versa with sellers. And finally, they believe that prices are non-random, and that patterns will form and repeat. And in fact, that particular patterns that they recognize and study occur and repeat themselves over time. Now, underlying all three of these core assumptions is the belief that market and prices are affected by human psychology. The market participants may be emotional and act irrationally. And finally, the participants may move in a herd-like behavior. So when you introduce human psychology into the buying and selling patterns of the market, that will explain why these particular patterns form and repeat. And will also explain why supply and demand is so important. And the herd-like behavior can kind of explain why trends occur in the markets. So it's very unique in that human psychology plays a large part in technical analysis theory. So what do technical analysts do? They use charts to make their investment decisions. That's the main point. Their primary tool is the chart. They aim to spot trends as quickly as possible from those charts and trade advantageously with the insight, i.e., the first to spot the right trend will make the most profit. Secondly, I've got a spelling error there. Secondly, they view their trades and price predictions through the prism of probabilities and are often more prepared to cut their losses earlier. For example, TAs often use stop losses when, for instance, the loss outcome occurred. So while some fundamental analysts maybe have more conviction that over time a forecast valuation of a stock may occur, TAs kind of believe, well, there's a 70% chance that the stock will go to here and a 30% chance it won't. So they look through the prism of probabilities and likelihoods. So what do TAs look for within their charts? Overall, they use price data, volume data, or a mathematical function on that data to generate indicators that create the buy or sell signals for their investment decisions. Now, when we talk about price indicators, that introduces topics such as support lines or resistance lines, or support prices or resistance prices. When we talk about volume indicators, we're trying to find the strength or weakness of a price move, or perhaps study the actions of institutional investments, or colloquially referred to as the actions of whales. And when we have mathematical indicators, this time we do things like put moving averages or Bollinger Bands on the price levels. Okay, we'll go to a real world example. We'll have a look at support and resistance levels. We'll look at strong and weak moves, and we'll look at Bollinger Bands. Now, note this is a very, very brief introduction, just so we're not looking at a slideshow. This is not supposed to be an in-depth analysis of technical analysis techniques, volume analysis, or the mathematical logic behind Bollinger Bands. So let's just have a look at a very quick introduction. Okay, so this time we have the Bitcoin price measured against the US dollar. I think it's from Coinbase. You'll see the current price of it is 7060. Okay, when we talk about support and resistance levels, we're talking about particular prices that have historically shown support and resistance beyond movements below or above those particular prices. So human psychology kicks in at particular price levels, which stops in the case of a support line, too many more sellers entering the market, and the price doesn't fall below that level. And when we talk about resistance levels, these are particular price levels where human psychology and memory of particular prices causes the buyers to exit the market and the price not to rise beyond the resistance level and possibly fall away. The way you find these particular support and resistance levels is you draw lines where they appear to be observable. So down here we have a support level where it touched a support level here, touched it here, and again touched it here, but rarely did it break through. Often when it touched the support level, it would start rising again. So here it almost touched it there and rose. Here it bounced along the support level and rose again. Here it touched it and rose again. And here it touched it and rose again. And so it's by kind of like connecting the dots between these particular price levels which appear to show support, you will find that it's difficult for prices to fall below those support levels. Now the exact mirror is in the case of a resistance line. Now this is where you find particular price levels where the stock or security finds it hard to punch through and get higher. Now whether this is because of human psychology and memories that people sold out last time, so it becomes a self-fulfilling cycle, so you follow the same method. You find these particular levels where it hits and falls away, it doesn't get through, and you join the lines to create a resistance line. And I've done one here in blue. You see it hovers around there, then it hovers around here, doesn't get through and falls away, then it hovers around here, doesn't get through and falls away again. And then even here where it has broken through in the past couple of days, you find the Bitcoin price kind of punched through 2 or 3 times before it actually broke the resistance line. And that's what we're referring to in terms of support and resistance levels in technical analysis. Now when we talk about volume and how that can indicate different stories of the market, if we go down to these, see these 2 volume bars here? Now they're very similar in height. They're not way up here. They're just 2 almost identical volume bars. But here we see on this first one, now the stock, I beg your pardon, the Bitcoin fell, but only a little bit there. But here we look at the next day, almost identical level of volume, and Bitcoin fell maybe 3 or 4 times compared to the previous day. So sometimes you can use volume to think, oh, well, what's the psychology behind the market? So on this first day, there may have been a bit of selling and a bit of buying. And the sellers won the day, the bears won the day, and the price went down a little bit. Now, the next day, with the same number of trades occurring in the market, it fell much, much more. So the psychology behind that, you might assume that, okay, in this second day, the bulls have given up, the bears are winning, there are no more buyers in the market, and the price of Bitcoin falls down much faster because there are no buyers to support the price. And if we believe that hypothesis, that the bulls have given up and the bears are the winning the day, then that could explain why the price of Bitcoin continued to fall for a number of days beyond that. Now here's another example of volume to kind of understand the psychology of the market, this second arrow. And here we see increasing level of volumes on bullish days. So we have the green bars showing that the price has gone up. And then we have it's an update there with very low volume. an up day there with slightly higher volume, an up day there with higher volume still, and then another up day there with even more volume. And this is perhaps the psychology is saying it's a very, very bullish market. Not very bullish, but there's a lot of confidence in an upwards movement in the market. More and more people are more and more convinced that the price of Bitcoin is going to go up. So we have those days up, 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 and then you can see it rises all the way up to there before it drops back down again. And finally, we talked about Bollinger Bands. So let's just put that indicator. This is the mathematical function. So we've had a look at the price action, we've had a look at the volume action, and now we're looking at a mathematical function. And this is interpose a set of Bollinger Bands and a center line on top of all of our price action. Now this is performed some sort of statistical analysis on the particular prices of Bitcoin, and this can help generate further buy and sell signals. So for example, this center line here is the exponential moving average of Bitcoin, and these channels are 2 standard deviations away of the center line. So in periods of high volatility, the channels will widen. In periods of low volatility, the channels will shorten. And the general logic of Bollinger Bands is when the price breaks below the lower Bollinger Band, then you should buy. It's a signal to buy. And when the price breaks above the higher Bollinger Band, it's a signal to sell. Because if you know anything about normal curves and 2 standard deviations away from normal curves, it's approximately 95% of all occurrences occur within these channels. So if it's at this tail, then you can assume that you might have to sell, and that would have been a good indicator there. And here's one down here where it's broken down the bottom, and if you bought there, it would have been a good indicator to buy. But again, this is not in-depth analysis. This is just a quick introduction about using price levels, volume data, and mathematical functions to generate buy and sell signals. So let's get back to our slide, and that was our real-world example. Okay, so finally we're going to talk about the advantages and disadvantages of technical analysis. Now, as for the advantages, firstly, it's easy to understand and grasp quickly. The basic theory doesn't have a steep learning curve. So while there is some very expert technical analysis and a lot of theory behind it, the fundamentals of it isn't that too difficult to understand. We just showed you that example in 3 or 4 minutes, and it wasn't too difficult to grasp. And then secondly, once you understand it, a quick glance at the chart is often all you need. So once you have the basics, you don't have to do 2 hours of model building and 6 hours of research. All you got to do is have a quick glance at the chart, and you have a pretty good idea about whether you want to buy, sell, or do nothing. Now, secondly, TA doesn't rely on financial statements nor company information. And this can be an advantage because there's no need to understand specialist accounting knowledge. And all you need is an easily accessible chart, not in-depth, hard to access company info that perhaps fundamental analysts need to do before they make their decisions. And the third advantage is it introduces human psychology into markets. And behavioral economics has made strong arguments that we don't act rationally, and our previous narrow models will not often hold. Now, anyone that studied accounting or finance or economics at a college level or high school, you'll know that a lot of the models sometimes they kind of assume away kind of real life. They say, oh yeah, given this and given that, and you kind of scratch your head going, well, why am I just assuming that'll occur? That doesn't kind of match up to reality. That's because human psychology messes up a lot of the narrow models that are often taught in other academic areas. Now, as for the disadvantages of technical analysis, firstly, it can rely too heavily on historical data. It only uses historical data, and the past isn't always a good indicator of the future. As the old saying goes, it always works until it doesn't. Secondly, rules and techniques are too subjective. Now, each technician may follow their own different rules and techniques. What you may do, or what I may do, or what a third person may do, maybe kind of what we feel and what we've learnt. So you'll see from that previous example, do you do the support lines at the very low point, or do you kind of just have an average, like where it all touches base? Do you set the Bollinger Bands to 2 standard deviations? What about the moving averages? Are you moving averages? Is it your 5 and your 15 day, or 5 and 20 day, or which one is it? Often it's too subjective. There's no core body of knowledge, and even the best technicians may base their own techniques on trial and error rather than fundamental theory. And finally, the third disadvantage is it violates all forms of efficient market hypothesis, or EMH. So while fundamental analysis allows excess returns under the weak form efficient market hypothesis, according to this theory, excess returns are not possible at all with technical analysis. And that's according to all forms of efficient market hypothesis, whether that's weak form, semi-strong form, or strong form. So if you're an advocate and a believer in EMH, then you're probably not a big fan of technical analysis at all. Okay, and that's it. What do we cover today? We talked about technical analysis summed up in one sentence. What are the alternative approaches to investment analysis between quant analysis, technical analysis, and fundamental analysis? We talked about who uses technical analysis and for what type of investments, and that is traders, and for more short-term investments, and for investments that don't pay income. We talked about the core assumptions and principles underlying technical analysis theory. We talked about what TAs do, what TAs look for within their charts, and then we wrapped up with the advantages and disadvantages of the technical analysis approach. Okay, that's it. I hope it helped. Best of success. There are your fireworks for getting to the end. If you enjoyed the video, please subscribe to the channel. The button will soon appear that you can click on. Watch another one of my tutorials now, or even just give me a like, or if you weren't a fan, you can give me a dislike. Finally, feel free to comment below if anything needs clarification or you just want to say hello. Thank you for your time.